So Warren Buffett just spoke out about the coming market crash, just like he did in 1999, right before the dot-com bubble burst, and in 2007, right before the global financial crisis. Even in 1969, we'll talk about that one in a minute, because that was a fun one and no one remembers that one. So look, every single time Warren Buffett has spoken out like this, he's been 100% right. So what is Warren Buffett seeing right now that the rest of Wall Street isn't? Well, that's what we're going to cover today. Today we're going to talk about the lessons we can learn from what Buffett said last week. We're also going to talk about why he sat on a record amount of cash and what we can learn from that too. And we're going to talk about why this should make anyone holding Nvidia, Palantir, or any AI stock really kind of scared. Before I start, my name's Nick. I've been a professional investor and unprofessional trader for 25 years now. I'm getting old, damn. I'm not a financial advisor. This is not an inducement to buy or sell any assets. And as always, do not take financial advice from some random dude on YouTube. Now, let's figure this out together, guys. So what's happening right now has happened before, because history has a way of repeating. The AI bubble is almost a carbon copy of the dot-com bubble, and Warren Buffett gave the exact same warning in 1999 before that bubble burst that he gave last weekend. Well, it's a similar warning. It's not the exact same. I'm exaggerating. So to understand what's happening right now, let's talk about 1999. Height of the dot-com bubble. This is a fun story, by the way. Get ready for this. So Allen and Company was throwing its annual conference up in Sun Valley, Idaho. It's like the most exclusive billionaire summer camp on earth. Bezos was there, Bill Gates was there, a few other members of the list that shall not be named. I shouldn't say that. Allegedly. So the CEOs of every dot-com darling you ever heard of were sat there in that room. And they have just had the best year of their lives. I mean, the NASDAQ was up 86% in 1999. People were quitting their day jobs to trade pets.com. A 24-year-old kid could walk into a bar with an idea on a napkin and walk out with a check for a few $1 million, as long as that bar was on Wall Street. Does this sound familiar, by the way? Today, you slap AI on your company's name and investors throw millions of dollars at you. History really does repeat, doesn't it? Anyway, the whole room is high on its own supply, essentially. Then Warren Buffett walks onto the stage and he tells the room of tech billionaires that the party is over, the music is stopping. What a legend. Seriously. He tells them that their valuations make no sense at all. He pulls up a chart of the car industry, explains that there were 70 manufacturers in America at the start of the 20th century. He asks, how many are left now? Well, the answer was 2, maybe 3. Then he asked about airlines. 300 airplane companies got started in the early days of aviation. He asked, how many are still trading? A handful of them was the answer. The rest went to 0. And he's basically telling the room, you guys are about to be the airplane companies. The room laughs at him, right? The press laughs at him. Barron's actually puts him on the cover of that of their paper that year, of their magazine rather, with the headline, "What's wrong, Warren?" Like the 68-year-old guy had gone soft. He was 68 at the time. Like he couldn't keep up with the new economy. That was the word on the street. He's too old. 8 months later, NASDAQ starts collapsing. It loses 78% of its value over the next 2 years. Most of the tech companies in that room on that day, the people who were there laughing at him, they went bankrupt. They had to sell their boats, their Rolexes, their wife's jewelry. Oh, sad for them. Anyway, Buffett, Berkshire Hathaway is Buffett's company, if you don't know. Their stock went up 28% that year. The NASDAQ fell 39%, right? He didn't predict the exact week. He didn't try to time the top. He never does. He just looked at the maths and said, this cannot continue. And he was right. But this wasn't the first time that he'd done this. In May of 1969, Buffett sat down and wrote a letter to all his investment partners. He had a small fund back then, it was kind of early-ish days for him. And in that letter, he basically said, I'm closing the fund. I can't find anything cheap to buy. The market is full of speculation, he said. Aggressive money is everywhere. I'd rather give you your cash back than chase prices I don't believe in. Look, the fund had returned almost 30 times the partner's money over 13 years. So he was at the absolute peak of his power, and he just walked away because he couldn't find anything valuable to invest in. What happened next? Stocks went sideways for the entirety of the 1970s. Investors who bought in the 70s chasing the hype got absolutely destroyed. Side note, by the way, those who bought gold and silver, they did very well, which is why I also hold a lot of gold and silver right now. Anyway, This also happened in 2007. Buffett spent the year selling stocks and stacking up on treasury bills. He didn't go on TV and scream sell. He just kind of stopped buying. By the time the music stopped in 2008, he was sat on the biggest cash pile in Berkshire Hathaway's history until now. I mean, he's sat on more cash right now, which should tell you something, but we'll talk about that. Anyway, the 2008 crash happens and he puts $5 billion into a distressed and collapsing Goldman Sachs. Well, collapsing is a stretch, but into a distressed Goldman Sachs, or Goldman Sachs. I think he made like 2 or 3 billion from that. I think it was free. He then throws 3 billion into General Electric. He bought the blood essentially, and he made an absolute fortune doing it. So his pattern is not predicting crashes, it's preparing for them and waiting patiently. And this isn't even rocket science, guys. See, Buffett knows something all of us know. All of us know this internally. When something is grossly overvalued, it eventually corrects. You don't need to be a rocket scientist. You don't need to be a genius to know this. He just has the balls to call it out and the patience to wait for every other idiot in the room to realize. That's why he's one of the best investors, or some would say the best investor of all time. Which brings us to last week. Buffett is sitting on stage at the Berkshire Hathaway annual meeting, well, in the audience, but this time something is different. For the first time in 60 years, he's not the one running it. He stepped down as CEO on January 1st. Greg Abel is in the chair now, and Warren, he's just sat in the audience. I mean, this was his last big public statement as the boss, or, as at the conference. It was his goodbye address to the markets. And what does he say, right? 3 times since I've taken over Berkshire, it's gone down more than 50%. This is nothing. This is referring to the 10% retrace we had in March. He was talking about that correction. Basically, he's saying that the 10% dip was nothing, and a big dip is still coming. The kind where SPX loses half of its value, the kind that he's lived through 3 or 4 times in his 60 years. And then he says this: if there is a big decline, we will deploy capital. The operative word is that in that sentence is big. A 10% pullback isn't big. A 15% correction isn't big. Buffett's not interested in any of that. He's waiting for another 2008 or another 2009, both of which he made billions from. That is the only environment in which he wants to buy. So what does he have ready to deploy? Well, he has roughly $373 billion. That's a lot of money. That's the size of Berkshire Hathaway's current cash pile, cash and treasury bill pile. It's the largest position in corporate history. And I'll remind you, last time Buffett was sitting on a record cash pile was 2008. And that is a big number, by the way, $373 billion. That's massive. It's bigger than the entire market. I looked this up. It's bigger than the entire market cap of Bank of America. It's bigger than the GDP of Denmark. But funnily, it's only half of an Elon Musk worth of money. So if you cut Elon Musk in half, he's worth roughly $373 billion. Anyway, it's just sat there in treasury bills earning 4% for him. Some of it is in cash. Buffett has been building this cash pile for years now. He sold Apple, he sold Bank of America. He still holds some of those, of course. He sold Kraft. He's never done that before in his entire career. Not in 1999, not in 2007, not ever. He's selling Kraft now, though. And it's not just that he's selling. The Buffett Indicator, his own kind of pet metric, let's call it, the ratio of total stock market cap to US GDP is currently sitting at 230%. I need to put this one into context because it's an insane number. That indicator was at 150% the day before the dot-com bubble burst. It was at 110% before the 2008 crisis. Today, it's at 230%. Basically, this indicator is a measure of how overvalued the stock market, and it's overvalued. It's a measure of how overvalued the stock market is. When the entire stock market is higher than the US GDP, it's overvalued, according to Buffett. Like I said, other crashes, it was at 110%, 150%, now we're at 230%. That is an insane amount of overvaluement. Whatever. And Buffett himself, decades ago, called this exact indicator probably the best single measure of where valuations stand at any given moment, right? So you have the inventor of the indicator looking at the indicator and saying, yeah, I'm out, bro. Although he doesn't say bro, but anyway. Buffett warned about something else the other day. He warned about the casino. When Becky Quick, the lady who was asking the questions, asked him about the current state of the market, he said, I would describe the current market as a church with an attached casino. People can move between the church and the casino. I would say there's still more people in the church than in the casino, but the casino has become enormously attractive to people. A church with a casino attached. Let me translate Wall Street grandpa for you. A lot of my mentors back in the day, they weren't quite as old as Buffett, but they were kind of close. So I speak the language. This is what he means. So the church is the real economy, companies making things, selling things, paying dividends, the boring stuff, the stuff that Buffett generally likes, the stuff I tend to like for the most part. I mean, I do buy some AI stocks sometimes, but I mostly like boring stuff. And the casino is the rest of it. The zero-day options, the meme stocks, the leverage ETFs, the crypto. I don't know why I said that. Anyway, he's also obviously talking about the AI hype names that are trading at like 100 times of revenue. And Buffett's point is that yeah, technically the church is still bigger, but the casino is pulling people in faster and faster every day. And that's the bit that worries him. It's the bit that worries me. It's the bit that should worry you. He didn't stop there. He named the worst offenders directly. He said, if you're buying and selling single day options, that's not investing and it's not speculating. That's outright gambling. Again, let me translate Wall Street grandpa for you. This isn't really grandpa, but he's talking about 0 day to expiry options. They were a niche product 5 years ago. Now they make up over half of all S&P 500 options volume. Most of that is retail. People with Robinhood accounts who 5 years ago bought index funds are now buying lottery tickets on whether the S&P closes up or down on a Tuesday. Buffett is calling it what it is. It's gambling. It's the biggest source of volume in the S&P options market, and it's just people gambling on intraday moves, and it's swallowing the market. But here's what Buffett left unsaid. The reason the casino exists is because Wall Street wants it to exist. The banks make money on every options contract. The brokers make money. The only person in the whole ecosystem with a financial incentive to tell you to sit on cash is the one guy who can afford to do it. Warren Buffett. Look, it sounds like I'm fanboying Warren Buffett. I'm not. Really, I don't trust any billionaires, but if I had to put them on a list of the ones you can trust, I'd say Buffett is like in the top 3, probably the top 1. But the thing is, it's because Buffett doesn't run a bank. He doesn't make money from screwing you over, technically, whereas most of these other ones do. So the rest can't call out the bullshit because their bonuses depend on you not hearing it. So you've got a generation of investors who started in 2010 and they've never seen a real bear market. They think that a 10% drop is a crash. And technically on paper it might be, but they think it's a horrible, horrible crash. And they've been told for 15 years to buy the dip and stay the course. And the very people telling them that they're to do that are also the people running the casino. Buffett has seen this 3 or 4 times. He's seen 50% drawdowns in his career, and he's ready for another one. And that's the point. He's ready. He's not predicting a crash. He's never really predicted a crash. He's preparing for one. And when he starts preparing, that's kind of him sort of predicting it anyway. So what lessons can we learn from Buffett? That's what we need to talk about. And I'm going to break down 3 simple ones for you. Lesson 1. The market is always going to give you an opportunity. You just have to be patient. And I understand that's hard. You're sat there waiting. Maybe you've missed a move. Maybe you missed silver and gold. Maybe you're bored. But investing is boring, guys, especially for those who make it, those who get rich. Buffett spent his life being boring, but he's one of the greatest investors of all time. It's a lot of research, a lot of looking at numbers, and a lot of waiting. But there's one rule that is constant about every market throughout history. Be it the tulip mania of 1637, railroads in 1847, aviation, internet, crypto, and AI today. When valuations get crazy, the bubble always ends up popping. And I'm not saying that AI won't survive the pop, like internet did, like railroads did. Of course it's going to survive the pop. It's transformative technology. Even though I don't like it, it is what it is. And that's just my opinion, by the way. But that doesn't mean that a lot of AI stocks can't crash in the meantime. They can. So, be patient, and an opportunity is always going to present itself. Lesson 2, there's always some money to be made. Right now, Buffett has $373 billion in T-bills earning 4%. When Becky asked him directly what he was waiting for, his answer was, he shrugged and said, I don't know. He just knew he hadn't seen anything worth buying. And in the meantime, he was getting paid 4% to do nothing. Look, I don't agree with Buffett on everything. And I'll talk about that in lesson 3 because it's very important. I hold a bunch of gold and silver right now. I hold some stocks, but then again, Buffett holds some stocks too. But not everything is overvalued right now, in my opinion. There are certain pockets that you could argue are undervalued, and your job is to find them. That's your job as an investor. For me, it was gold and silver a few years ago, and now a little less so, although I'm still bullish on them. But right now I'm looking at energy stocks. I talk about them in my last video. I'm looking at copper. I'm looking at some uranium too. That's not financial advice, by the way. Talk to a financial advisor. I'm just pointing out that even when you're being patient, there are some opportunities, and those are the opportunities I'm personally looking at. Now, lesson 3, it's important to understand that you can't operate your portfolio in this exact same way a billionaire does. Different risk appetites, different goals, different timelines. So you don't want to copy Buffett, but you want to learn from him. And I think the greatest lesson we can learn from him right now is not to be overexposed. I'm certainly not saying sell all of your AI stocks. I'm not a financial advisor at the end of the day, but consider not being too exposed, not having your life savings wrapped up in stocks that are overvalued and could crash 70%. I saw the tail end of 2001. I lived fully through 2008. And I know when a market is overheated and when things are overvalued. I agree with Buffett. Do you?